Welcome, everyone, and thank you for joining this quarter's Corporate Cash Briefing webinar, now in our 6th year. Each day seems to bring a new twist and turn for corporate treasurers and bankers, and today we will examine several major issues. Today we're going to be discussing the Treasury Department's Rule 385 on commingled cash, which impacts most corporate treasurers around the world. We're going to be discussing money market reform. In the U.S., we're exactly 3 months to the day away from implementation of the U.S. regs, and we have a line of sight into the EU regulations that are now being developed. We're going to be discussing Brexit, and we're going to be discussing beyond Brexit, which is a look at political and country risk that falls out and basically transmits Brexit into a worldwide phenomenon. And that's just to name a few of the topics we'll be discussing today. I'm Tony Carfang, and I'm a Managing Director at Treasury Strategies, which is now a division of Novantas. As most of you know, Treasury Strategies is the acknowledged leader in consulting to corporations and financial service providers on treasury liquidity and payment solutions. Novantas is the industry leader in analytic advisory services and technology solutions for financial institutions, and with more than 200 professionals, Treasury Strategies and Novantas today combine to make a formidable team in both the bank and corporate treasury markets. I'm joined today by my Treasury Strategies and Novantas colleagues, Kevin Ruiz and Brett Friedman, as well as 3 panelists, Debbie Cunningham from Federated Investors, Steve Bassaby from the Association of Corporate Treasurers, and Roger Merritt from Fitch Ratings. Today we'll discuss the changes in corporate cash levels as well as the issues I just mentioned that are top of mind. As a quick aside, everyone who's registered for this session in a day or two will receive a copy of the presentation and a link to the recording on our YouTube channel. We invite you to visit this channel at your leisure. Just go to YouTube and search Treasury Strategies. We'll be at the top of the list, and there is plenty of interesting content. Should you wish to ask questions, you can do so in the question box in the bottom right-hand corner of your screen. We will handle these questions offline after the briefing. Thank you very much for joining us today.
Thank you, Tony. So this will be my first time talking about our corporate cash levels, so I hope all of our audience is going to be nice to me today. As normal, we look at the 4 major jurisdictions, looking at slide 4. The story really isn't changing for corporate cash levels. In the U.S., as we look again at slide 4, we see our old friend tapering. And for all these, our questions with Treasury Strategies is, how much of this is technical change versus how much is structural? And as always, we welcome the thoughts from our audience. In the UK, the cash level looks like it's doubled during the time series. But we noticed something when we were looking at the numbers over the last few days, that there's a slowdown every 3rd quarter. Now, Brexit's going to impact the numbers in the next quarter. Coincidentally, that'll be October 14th, which is the same day that the money market fund reform goes into effect. And that'll be a very interesting discussion, which we're going to get into with our panel here in a bit. If you look at the EU, pretty solid line growth, 2.5 times, moving from about 1 trillion to almost 2.5 trillion. And then in Japan, you can see the pace of acceleration is accelerating, for lack of a better word. As we move to slide 5 and looking at the regressions here, the story, again, it's not really changing. There's a reflection of economic events as well as decisions in terms of monetary and fiscal policy for 3 of those jurisdictions that it shows a solid fit and a solid climb. And then there's Japan. Not a fit. You see that the regression shows 0.77. And that's due to policy differences, macroeconomic differences, and I think what we're thinking about Treasury Strategies is perhaps Japan didn't do as much in terms of monetary and fiscal policy as the other major jurisdictions did going into 2008. Everyone else was rising very quickly going into from 2000 to 2005 or 6, so that looks like a difference to us. On slide 6, as we look at cash as a percentage of GDP, it's still high, particularly outside of the United States. The other jurisdictions rose rapidly relative to the United States. Tony testified on this. In Treasury Strategies' opinion, the cash as a percentage of GDP ratio is a major measure of economic efficiency. And obviously correlation isn't causation, but it shows generally how much cash it takes as a percentage of GDP to feed economic growth. Again, we would be very interested in hearing what our audience members have to say about this. As we move to slide 7, you'll see the correlations relative to nominal GDP for three of the majors. And again, Japan is a different story. And again, we suspect this is due to both structural as well as technical issues. On slide 8, the central bank's reserve balances, you're seeing, if you look at the United States, QE, QE, and then again, our old friend tapering. Bank of England is what we're calling the flat 4. Last 4 years looked relatively flat. The European Central Bank has somewhat of a roller coaster going on right now. And then in Japan, you see the effects of Abenomics and other macroeconomic drivers. And then, there's also been recent moves to reduce the growth forecast. I believe they announced this in the last few days that they were going to reforecast their growth for the remainder of the year. And finally, on slide 9, you see the central bank balance sheet that includes all assets as a percent of GDP by region. It closely mimics the reserve balances, but it adds in those total assets. So GDP growth being the denominator of that equation, that growth will have a negative influence on these numbers in an absolute sense, but maybe not in a trend sense. And you see that depression in the factor in the Bank of England. It's a very obvious indicator there. So, Tony, I'm going to hand it over to you to talk about the Department of Treasury IRS Rule 385.
A top issue on the minds of treasurers today is the Inversion Rule. IRS Rule 385 is a proposal likely to be enacted very shortly, designed to curb inversions. That's U.S. companies merging with offshore companies and moving their headquarters overseas. But the rule as written, and we want to explain that today, has the potential to fundamentally change corporate cash management and banking structures for just about every medium and large-sized corporations. Now, Treasury Strategies is on top of this, and in fact, we've commented on this to the Treasury and the IRS. The rule is actually called the Treatment of Certain Interests in Corporations as Stock Indebtedness. Kind of an interesting title because it really explains the mechanics of how the rule works as opposed to the objective of the rule. But the primary intent is to reduce or eliminate corporate inversions. A secondary intent is to penalize a practice that the Treasury refers to as earnings stripping, that is, companies adjusting their transfer prices in a way to shift earnings into lower tax jurisdictions. Now, there's already an OECD an initiative underway called base erosion and profit shifting, and that's been underway for a couple of years. It kind of makes this redundant or from the standpoint of a corporate treasurer, it makes life a lot more complicated. Now, while those are the objectives of the regulation, the practical effect is to put at risk most Treasury management programs and the supporting bank services. And it does this because it essentially looks at commingling of corporate cash across business units as a manipulation, as something that is not a good thing. Now, the IRS proposes several tests that would make cash commingling acceptable. However, those tests are very complex and very detailed and almost impossible for a company to meet on a daily basis, and they are accompanied by serious penalties such that most of the corporate treasurers with whom we work here at Treasury Strategies are, at least at this point, unwilling to take the risk of tripping one of the tripwires. And the problem is that in these routine transactions where, business unit A lends money to business unit B and pays it back tomorrow, and this goes on, ad infinitum, the IRS will have the authority, should you not meet all of the myriad tests in place, to reclassify your debt as equity. And therefore, the corporation loses interest deductions, tax credits, and, there's a whole cascading effect of penalties that kick in. Many of our clients, and much of what you read indicates that this is really about cross-border transactions and moving monies across jurisdiction, but we will point out right in the preamble of the Act, we have this quote here at the bottom of the page: "The proposed rules apply to purported indebtedness issued to certain related parties without regard to whether the parties are domestic or foreign." This, frankly, at Treasury Strategies, we're mystified at why Treasury would have thrown this particular phrase in right at the end of the preamble, except to say, we're going to be watching everybody here. Now, why is this a concern? Well, first of all, it impacts routine cash management practices. Most banking structures and corporate cash concentration systems really, roll money up from subsidiary levels into a centralized cash pool. It may be within a country, it may be, across countries, in pooling structures. But this is a common cash management technique that we point out in our comment letter. Even the U.S. Treasury itself uses. So go figure. One of the things that's required in order to escape the draconian penalties is extensive documentation of intra-corporate funding. So if you're going to commingle cash in a cash pool, on day one, Division A lends money to Division B. On day two, Division B pays it back. Each of those is actually a separate loan under 385 and requires documentation up to and including an independent credit analysis of the borrower. So, today subsidiary A has to actually do a credit analysis and document that analysis, and then tomorrow B does the same on A. I mean, obviously impractical. There's a very low threshold here of only $50 million that will basically impact every company on this call today. What's really complicated here is that the 385 has a 3-year look back and look ahead, so that if any of the divisions or subsidiaries or countries involved in an intercompany lending or cash pooling scheme fall afoul of these rules, anytime 3 years prior to 3 years in the future, then today's transaction is deemed ineligible, and any other transactions of that business unit is disqualified from being in the cash pool. So any prior or subsequent transaction that any other business unit had with that business unit is now infected as well. So this cascades and basically infects the entire cash pool. And again, the penalties are the reclassification of debt into equity or even a hybrid at the discretion of Treasury. Now, as we commented to Treasury, the rules go far beyond the scope of corporate inversions, and they basically touch basically every mid-size and large American business, as well as most non-U.S. headquartered companies doing business in the United States. So the reach is extremely broad, extremely far and wide, and this reduces, increases cost and reduces capital efficiency. There are impacts to both the banking system and to corporate treasury. Let's talk about the banking system first, because as we looked at the other comment letters submitted to Treasury, no one quite pointed this out. But as companies have to restructure their banking systems so that there is no more intercompany lending, what happens is what used to be a stable deposit at a bank, the corporate cash pool is kind of flat because all the debits and credits are netted inside the cash concentration structure. It now disaggregates a company's stable cash pool and breaks it up into many smaller and by definition more volatile cash pools. So what we have is a less stable funding source at the same time that Basel III is requiring banks to develop more stable funding sources. That's a huge complication. Now, in addition, from a bank perspective, banks have a nice low-risk revenue stream from the cash concentration services and the information services and the pooling services that they provide to corporate treasurers. Again, from the standpoint of the safety and soundness of the global banking system, that is a good thing. It's very low risk, and it's stable revenue, and that will conceivably be lost. So, there are issues that we point out to regulators that they need to be concerned with regarding the banking system. Now, corporate treasury is impacted in a number of ways. It's very likely that the companies, in order to comply, will reduce their level of intercompany lending. And the way to do that, if Company A cannot fund a shortfall, or excuse me, if Division A cannot fund a shortfall in Division B, that means Division B just needs to hold more cash so that there is no shortfall. And again, in our comment letter, we point out that if this causes an average company to have to hold an extra 5 days additional cash flow on their balance sheet, then companies, just the Fortune 500 companies alone, will have to hold an additional $230 billion of stranded cash on their balance sheet. That is, you're going to have to raise another $230 billion to make sure that you don't require or to supplement the intercompany lending that you might have been doing. In addition to that, companies will need to change their cash concentration systems to make sure that these pools don't cross-infect each other and that the cash flows can be absolutely seen and documented as they go up and down the line. That means changing concentration structures, banking services, pooling structures, and the related technology around your treasury management systems. That's clearly complex. One of the things that leads us to believe that the U.S. Treasury is not taking the corporate community's concerns seriously is that in a side publication, the Treasury is required to do a cost-benefit analysis and determine what the cost to corporations will be to do all the things that we just talked about, and including all the tax opinions and accountants' opinions you're going to need in every country in which you do business. In their cost-benefit analysis, the Treasury said that aside from a few large multinational companies, most companies will incur an additional 35 hours per year of additional work to do everything that I just talked about at an average cost of $18 an hour. Now, think about that. Think about what the Treasury is saying here. They're basically saying, we don't care what you have to do. And we're going to totally discount that. That pretty much tells us that the Treasury is taking a hard line here. So we actually proposed a path forward, and we'll keep you posted on this. We requested that Treasury more narrowly draft those sections of 385 that lead to the unintended consequences that we point out. We asked Treasury to enumerate specific cash management practices as being outside the scope of 385, to define a safe harbor that is unambiguous so that you will know that if you do certain things, you will not run afoul or accidentally hit a tripwire and contaminate your entire pool. And for the purposes of routine corporate treasury transactions, eliminate the 3-year look back and look ahead. You can see our analysis on the website that we have there, and also we're putting together. We'll be doing email updates, and if you would like to be on our email update list, just send us your. Send an email to me at Tony_Carfang at treasurystrategies.com, and we'll keep you posted. Thank you.
Thank you, Tony. So we're going to move on to our panel discussion. And with us today is Debbie Cunningham, Chief Investment Officer of Federated Investors, Roger Merritt, Managing Director of Fitch Ratings, Steve Baseby, the Associate Policy and Technical Director with the Association of Corporate Treasurers, and we're also going to have with us today Brett Friedman, who's a Director with Novantas. So the first of our three subjects we're going to talk about is money market fund reform. Winter's coming, everyone. October 14 of 2016 is getting near, and coincidentally, that's the same day that we'll be having our next quarterly cash briefing. As we approach October, corporate behavior may be changing rapidly as well. And Debbie Cunningham, I believe you're on the line. You and I talked about the strike time announcements, and we talked about discussing some of the floating NAV products. Maybe you'd like to start by talking about what that is and the implications for corporate treasurers.
Sure. Can you hear me okay?
Absolutely.
Okay. So, there were lots of announcements about, at the beginning of the year, about what funds would be institutional and what funds would be retail. And the implication with that is whether or not there needs to be a floating net asset value product for the prime and municipal sector, or whether it's a constant net asset value, the same dollar in, dollar out product that we've gotten used to. So for those that are institutional prime or institutional municipal and that that will be having a floating net asset value, the announcements over the course of the last several months have been centered around strike times. And ultimately what that means is you're able to process transactions, a customer is, on a purchase and a redemption basis, always on a look-forward basis to what the next calculated price is. And with a constant net asset value product, that's virtually all the time, because it's just always amortized cost priced at $1 unless there's some event. With a floating net asset value calculation, that's actually a little bit different, and there will have to be specific times during the day when the price is recalculated so that the flow of transactions from customers that have been collected, all the purchases and redemptions that have been ordered by the clients, can then flow through. So basically this will be the fund companies, through the utilization of our custodians, accountants, and pricing vendors, actually repricing these portfolios on an intraday basis. For Federated, we've chosen two different models. We have a multi-strike model and a single strike model. The multi-strike model will have 3 times per day that the funds will be priced. We've chosen 8 a.m., noon, and 3 p.m. And so basically, if you place a transaction at 11 o'clock in an institutional floating net asset value fund that has its next strike time at noon, you will be put in a queue for pricing and clearing of that transaction upon receipt of the next strike time, that strike time starting at noon. So at noon is when all of those transactions are queued into, sort of a holding tank and waiting for the price to come back from the pricing vendor, the custodian, the accountant. That's processed each time there is a strike. Will probably take anywhere from 1.5 hours to 2.5 hours. Ultimately, that's the time frame then after that strike time. So in my example, after the noon time, when the transaction will clear, when the purchase order is actually received or when the redemption is actually sent out. So there's, a little bit more of a time delay throughout the day. There's also what's called a single strike model, and basically we've been told by many of our intermediary customers that they prefer not to have any of their customers ultimately get different prices potentially throughout the day. Now, while we think there's very little likelihood of an actual price changing throughout the day, of the NAV actually changing throughout the day, if there was some sort of an event, that certainly could happen. And as such, we have intermediaries that want just a single clearing time and a single strike price for their customers and aren't really sensitive in the context of what time of the day that is. So there's a 3 o'clock strike time then for a single price model for those customers that necessarily don't want to potentially have different prices throughout the day. I think probably the biggest thing with regard to these changes is not even necessarily the striking of the price and then the clearing of the transactions. It's essentially the backing up of the final transaction time. So ultimately in today's market with amortized cost pricing, customers are used to transacting in a money market fund on a same-day basis up until 5 p.m. for both purchases and redemptions. For the floating net asset value products, at least initially, because of the time that it takes to do that calculation and the deadline for wires being that of the Fed wire system, those funds are going to have their last purchase and redemption acceptance time on their last NAV strike of the day. And in the instance that I was talking about before, this would be at 3 o'clock. So there will be a window of time between 3 and 5 that for customers who are used to taking and utilizing late day transactions in money market funds, they're going to have to go to and if they are institutional, they're going to have to go to the government side of the equation because those latest 2 hours will only be able to be satisfied in that regard. Ultimately, we do think we'll be able to push the process. So if you think about it, we have vendors and custodians and accountants who have been used to doing this pricing process once a week historically. In the most recent times over the last several years, they've been doing it once a day, and it's due the next day. We're now asking them to do it 3 times a day and very quickly, and their very quickly is not real quick yet. It's, like I said, anywhere from an hour and a half to 2.5 hours. Our expectation that would be that as they get used to this process and clarify it a little bit more, that time frame for dissemination will grow shorter, in which case then that 3 o'clock last time frame for the NAV strike will be able to move out. But that's months down the road, certainly not on initiation on October 14th. October 14th will show multi-strike or single-strike models with the latest in the day for institutional prime and muni funds being 3 o'clock, most likely.
Thanks, Debbie. That was a master class in that, right? I appreciate it. Hey, Roger, with Fitch Ratings, when do you think you're going to start seeing corporate treasurers start to move money? And then also, what other implications do you foresee that maybe aren't top of mind of our audience this morning?
Sure, Kevin. Well, I think we're starting to see some of that movement happening already, just in the last couple of weeks. In the aggregate, there's been about $300 billion that's moved out of prime institutional money funds into government funds. The bulk of that, however, has been the fund complexes themselves proactively converting their prime institutional funds to government funds, in expectation that that's where the demand's going to be from many of their clients. But more recently, we've seen, just under $100 billion move out of prime institutional funds, so I think we're starting to see the corporate treasurers and other institutional prime investors starting to vote with their feet. But it's been, I think, for us surprisingly very much a wait-and-see attitude on the part of corporate treasurers. I think they're still sort of debating internally what they want to do and what that means for them in terms of how they're going to deploy their liquidity and invest their liquidity. In terms of the implications, I think a couple things that come to mind. One is, this is clearly going to be, money fund reform in October is clearly going to be a sea change for how many corporate treasurers manage their cash. We like to say that, the money funds used to offer, the best of all worlds, a reasonably attractive yield, same-day liquidity, and a stable NAV. In the case of going forward, you're not going to have that same triad. You're going to have to sacrifice something. If you go into a government money market fund, you're very likely going to have to sacrifice yield in order to get a stable NAV and have access to same-day liquidity. So what we're telling corporate treasurers is they need to really take a hard look at their investment guidelines and really make sure that they have thought through what their needs are. They really understand how the markets are changing, and they have appropriate strategic flexibility in their guidelines to navigate the the new waters that they'll be facing post October.
Thanks, Roger. Hey, Steve, you made a comment to me the other day when we were talking about money market fund reform. You made a comment about European Bank Authority guidelines. Perhaps you want to quickly elaborate on that as well.
Well, we have a similar development going on in money market funds, although it may be slightly forestalled in the European Parliament as they start to get into the Brexit process. But I share the comments there and the concerns that corporates will they haven't really digested the idea of gates and fees and the potential for their ability to get money out and exactly the same amount of money as accurately as they have in the past. And that is coming at the same time that the EBA are implementing some rules for short-term cash management, which ironically have the same effect as your IRS rules, that it makes pooling and netting far less attractive. It effectively says you can carry on pooling, but the money becomes worthless. These two factors coming together are going to bring about changes, and we're making the same points to our members, that they have to start thinking through exactly what their policies are and how they work and how they explain those to their boards and how they'll work in the real market. Contradicting that is that we've seen the rise in the amount of cash they're holding, as shown in the earlier graph, but some of that can probably be put down to people pre-borrowing and parking money in their subsidiaries ahead of the Brexit vote on the basis that something might go horribly wrong with liquidity, although it hasn't in the short run.
Right.
But yes, we have got this strange interplay going on in the short term, and money market funds beginning to look as though they're not as reliable as they've been considered to be. The EBA bringing in similar rules on pooling or valuing the pooling, which will have the same effect as your IRS 385 rule coming in. And a question for treasurers of if they're going to keep sitting on all this cash, just how they're going to manage it.
Right, right. Thanks, Steve. I appreciate it. So we're going to spend the next few minutes talking about really a topic that we here at Treasury Strategies, and I think all of our panelists and probably most of you listening have been thinking about and talking about fairly consistently, and that's Brexit as well as what comes next. So we're going to start by talking about the British referendum, what we're calling Brexit, to leave the EU. Like I said, it's pretty much all anyone's been talking about, at least here in the United States, and I'm sure in Europe as well. The vote and then the coming Article 50 declaration, it's going to have both short and long-term consequences for Great Britain, for the EU, for European leadership in general, potentially other trade blocs, and the macroeconomic economy in general. Brett Friedman, as a director with Novantas, and I consider you to be a risk expert here, what are your initial thoughts about this?
Well, I can say, unfortunately, I was thinking about it this morning. Over the course of my career, I've lived through about 10 of these, possibly more, of these extreme shocks to the market, Brexit being just the last one. They all kind of follow the same pattern, which is very akin to the 10 stages of grief that markets go through: the shock, the emotional thing, the anger, the panic, the guilt, and then finally some sort of hope and accepting the reality of it. And Brexit, we're sort of in the last stage of here where they're accepting the reality, the market is at least, that something is going to, that it's actually going to happen in one way or the other. Unfortunately, what I think is that although that's true and the markets are calming down considerably, especially with what's been going on in the UK in the last couple of days with the election of Theresa May, et cetera, or the coronation of Theresa May, whatever you want to call it, there's still long-term issues with the EU, and Brexit was a symptom of problems within the EU. It wasn't a cause of these problems. It was a symptom of these problems that aren't going to be going away anytime soon. And there's things that are happening within the EU that can cause a reentry into the EU to be particularly problematic. The assumption that everybody seems to be making is that the EU is a stable entity that will be around in a couple of years, that Brexit, when they re-enter, that there will be something to re-enter to. And I think that's an assumption that's going to be tested over the next couple months to couple years. And so I don't think that although the market is calm now, I don't think that this is going to last. I think there will be extreme spikes in volatility as the probability of the reentry comes and goes and new problems emerge with the EU that questions its long-term viability.
Right. Thanks. Thanks a lot, Brett. You know, we were talking here internally that Brexit isn't a binary thing. You know, it isn't clear whether this is going to be a divorce or just a different defined relationship, right? So Steve Baseby, as the Associate Policy and Technical Director with the Association of Corporate Treasurers, you saw those stages of grief, right? You're in London. You saw everything go down. So let me ask you, what was the initial reaction there, and what do you think, generally speaking, comes next?
Well, the initial reaction for corporates was surprisingly muted, and that's because many of them are, in fact, multinational in their nature, even if not in their structure. And their reaction had been to, say, to pre-borrow where they were concerned there might be some liquidity issues, and to cover themselves with foreign exchange hedging for their movement of goods and services in and out of the country. And so we're in a stage which is called a phony war at the moment. Nothing much is happening and everybody's sitting around just getting on with life. The issue might emerge more as we go forward, as foreign exchange hedges start running off, and can costs be raised in the market. We just have to see where that goes. But from the capital markets concern, which is where we get the money from, it is more of a concern as to whether we preserve some kind of passporting or whether we have to rely on a purely domestic economy. But it's had some strange side effects which don't strictly affect cash management, but do tend to affect the markets overall. We've seen a surprising rise in equity markets and bond prices as people are chasing yield. We know that some of that is because particularly the top end of our stock market is dominated by dollar-based multinationals, so in fact their value has gone up in real terms. But we also see a quiet period where there's not much need for anybody to borrow, including government. And we are waiting to see what happens when the government does start to borrow in any meaningful way again.
Sure.
The phrase I use, challenging the market on those very low yields that are there. Right. And just is the risk that that's the moment of truth where everybody says that, yes, you have got a problem if you're going to detach yourself from this much bigger economy. The other point that I think is made there is very valid, that that much bigger economy in the Eurozone, we're not too sure where that's going either. We have French elections next year, where the idea of a Frexit is already being floated. We have a movement in Italy to exit the euro, but not the EU, which is quite strong. We have still no firm government in Spain, where there are similar debates over whether you're really getting anything out of being in the EU, be it Spain as being one of the countries which has received much of the EU largesse, as visitors will notice from his fabulous facilities. But there's this concern that the Euro bloc and the broader EU itself is not something that's going to remain stable. What this means for corporate treasurers is you could be getting into a period of extreme volatility, which you have to manage on a day-by-day basis, and the difficulty of pricing your imports and your exports.
Thanks, Steve. Thanks. Let's talk about beyond Brexit, just in the interest of time here. I mean, we all have a strong desire as humans for pattern recognition, and I think that bleeds a little bit into maybe crystal ball forecasting, but there's similarities, as you mentioned, Steve, in Brexit to other things that are going on globally, driven by populism, macroeconomics, any other influences that you can point to. You know, you mentioned issues throughout the rest of the EU. We have our elections here in the United States. There's challenges in the Bentic countries, and obviously we've discussed in previous quarterly discussions around Greece and Spain being on the radar. Brett Friedman, what are some other areas where our audience, and specifically corporate treasurers, should maybe direct their attention?
I think the most obvious one, which has come to the fore lately, but post-Brexit, but has been brewing since 2008 to anyone who's been noticing or reading any of the popular or any of the sort of specialty press, is what's been going on in Italy with their ongoing bank crisis, which has been intensifying over the last couple years to months. The basic situation being basically that Italy has about $400 billion US of sour loans on the banks have on their books, and that's roughly about 20% of their GDP is non-performing assets. Just to put that in context, that's equivalent in the U.S. to about $3.4 trillion of bad loans, which we do not have. One bank, interestingly enough, Monte dei Paschi di Siena, which is the oldest bank in the world, which was founded in 1472, believe it or not, has about 47 billion euro in bad loans. So what the Italian government, and this whole situation is a little microcosm of what's going on in the EU and the problems that it's facing. The Italian government wants to inject 40 billion to shore up their banking center. The EU has some, what they call, they have some rules that basically bondholders in these banks have to take the hit before any money can be injected into the banks. The problem being that in Italy, due to some tax laws, all of those bondholders are retail investors, small mom and pop, your grandmother, et cetera. And so failing some sort of compromise, you know, there's going to be a real problem. Of course, the EU has been saying that there is going to be no compromise, and everybody knows there is going to be a compromise. But this is a classic situation that the EU seems to get itself into on a regular basis. It highlights the north-south problem, creditors versus debtors, Brussels rules versus national politics, et cetera. And eventually, and they're going to paper this one over just like they papered Greece over, but eventually one of these things is going to come home to roost. And one of the biggest problems that we're facing with the EU is that the last couple of stress tests for the international economy has seen incredibly high correlation between markets.
Absolutely.
So when something happens in Italy, you know, it can affect U.S. markets very strongly and for a period of time. Yeah. And that's what I would worry about. So,
thanks, Brad. Thanks.
Sure.
Yeah. Hey, Roger Merritt, Managing Director at Fitch Ratings. Do you have more to add or a different view? I think we had talked about some follow-on effects here. I mean, what do you think? What's your point of view? What's going to happen next year?
Well, I think it is a bit of a crystal ball exercise. But I take the earlier comments that the EU has some real structural challenges ahead of itself. The point about the Italian banks, I think, is exactly right. We've recently seen that Spain and Portugal being singled out for sanctions for not adhering to EU fiscal policy constraints. Scotland has said that they will have a referendum to re-enter the EU, which I guess would be a reversal of the last referendum where they agreed to stay as part of the United Kingdom. So, what we see here is just an environment of extreme uncertainty, and we all know that uncertainty is not a recipe or a key ingredient for robust economic activity, which, you certainly see, you talk about one of the great challenges out there right now is just the great unknown with respect to low and even negative interest rates. We have $13 trillion of debt globally that is yielding a negative interest rate. So we're in uncharted, untested waters. And so
yeah.
I think that just means that everybody has to manage this very carefully and, as it was said, really on a day-to-day basis.
Thank you, Roger. Debbie Cunningham, Chief Investment Officer for Federated Investors. I'm going to let you close out our panel discussion. What do you think? What comes next? What does that mean for short-term rates? What does that mean for our Fed watchers in the audience?
Sure. I see everybody likes to focus on their own market, and for money funds in particular, I think there's a couple things. Number one, what the Brexit impact will be on Yellen and the FOMC. Obviously, we were in line for what we thought were 2 rate rises in 2016, and I'd say for the most part, we're down to 0 or 1 now from a forecast perspective, and it's all entirely based on Brexit because our own U.S. economy has been picking up speed at this point, and inflation has been actually improving. So that's a question. I do believe from our perspective that we're still on a single rate rise probably in September as a U.S. outlook. We also are concerned about what it does from a bank health perspective. Money market funds generally invest in a lot of banks, offshore as well as domestic, and what this does to the ongoing health of the British banks as well as some of the large global banks is a question we have. And then lastly would be offshore regulation. So we've been going through in the U.S. a lot of change from a money market fund regulation. We're all kind of waiting with bated breath what happens in October. The offshore side of the equation was actually sort of just coming to a head, and in fact, as I understand it, the first trilogue debating the offshore money fund regulations is still in fact happening today in Brussels and will continue next week. So I'm not sure what this does to derail those, prolong them, but in any case, that's a question for our industry also.
Thank you, Debbie. Thank you so much. And thank you so much to everyone who participated in today's panel. Steve Baseby, the Associate Policy and Technical Director with the Association of Corporate Treasurers, Debbie Cunningham, Chief Investment Officer for Federated Investors, Roger Merritt, Managing Director of Fitch Ratings, and Brett Friedman, a Director with Novantas. Most importantly, on behalf of Tony and the rest of our panelists, I want to say thank you all so much for attending today and for listening today. As usual, a link and copy of today's materials will be shared with all registrants in a few days. And of course, if you have any questions or comments, please feel free to contact me or any of our panelists at their respective emails being shown on the screen now. Thanks so much and have a fantastic day.
Thank you.